You cannot listen to Wall Street telling you everything has now been rectified. That was a rumbling of what is to come. And now that we have reached the 90 days prior to the US election in the beginning of November of this year, we are getting a lot of global intelligence from our colleagues that talk about the fact that we are and will have some sort of cyber attack. We will have a grid disruption before the election. Welcome, everyone, to this edition of Crashes and Taxes. I am your host of this podcast, Rebecca Walser. Our last podcast for Crashes and Taxes was at the end of June, and it is August the 14th today as I'm in the studio recording this. And I do want to apologize to you guys. I have been extremely busy with summer travel between work and personal travel. So it has been a very busy and crazy summer. And of course, the markets have been crazy and the world has been crazy, but everything has been going on in the world since the last time I've done a Crashes and Taxes update. So I just want to acknowledge that we are in extremely unusual times. I have been growing my practice exponentially, and that is just taken up a massive amount of my time this summer, along with all my travel. So that is why I have not done a Crashes and Taxes in a while. There's been a lot of updates, so I do want to kind of use this as a general kind of update to get you on the same page of where I'm at, and kind of let you guys know what I'm expecting to come in these 3 months, August, September, October, even though we're in the middle of August already. So we're in less than 90 days until the November election in the United States of America. And this is the time where everything is hypersensitive, and meaning that we are acutely in tune to what is going on before the election, because we are expecting 3 potential events to be brought forward before the election that will, in fact, even impact the election. So I'm going to go into those at the end. But let's go ahead and get actually started with the market update, kind of let you know what has been happening, in my opinion, there, and really what's to come. And then we will tie it back into what I expect to escalate before the November election, because we definitely do expect some escalation of things before the November election. So let's go ahead and get started with our actual slides. And this just is telling you it's the market update for August the 14th. And I do need this to be a little bit bigger. It's going to have to do. So the first thing I want you to understand is we are going to discuss the Japanese yen dollar relationship, and something that is being put out in the media extensively is called the carry trade. The carry trade. So a lot of people have never heard of this term before. What is a carry trade, Rebecca? What does that represent? What does that mean? And yeah, exactly. You want to know. So I'm going to take myself off for a minute. I'm going to let you see this. This is an IMF, an International Monetary Fund. And this is a publication from the IMF talking about Japan's public, meaning their central bank and their country's public sector balance sheet. And this was done in October of 2019. So what I'm trying to let you guys know is that this information, or this Japanese yen, US dollar situation, this has been going on for an extremely long time. The way that Japan has been able, and I have a affinity to Japan. I was a military brat. I was born in Japan, lived there first 3 years of my life. My brother was born there, my younger brother. So I actually have a soft spot in my heart for Japan. But it is absolutely unbelievable what they have done really since the 87 crash. And the fact that they've been in stagflation for really, I would say, since then. We have really seen little to no, we've seen economic growth, but we've seen no real return over the long term, it's been a long-term stagflation situation in their country. So that is the paper from the IMF in 2019. Then we have the Federal Reserve of St. Louis that literally just came out with a economic research paper, working paper series this past month in July of this year, July of 2024. So it was started, obviously this work was begun last year, 2023. So the reason I'm bringing forward this Federal Reserve St. Louis economic working paper is that it is to show you and establish to you that in fact, this carry trade situation is years and years, probably actually a decade in the making. So I want to just read to you this quick high-level summary from this Fed Reserve paper co-authored by the University of Pennsylvania as well. As a result of Bank of Japan's large-scale asset purchases, the consolidated Japanese government borrows mostly at the floating rate from households and invests in longer duration risky assets to earn an income more than 3% of GDP in expectation. In other words, the Japanese government is funding itself by basically borrowing, or basically they're paying money at short-term floating rates, extremely low, sometimes not even a half of a percentage of a point, not even a half of a percent, not even one half of 1% in maybe a money market account at banks, short-term duration assets, whereas they are investing in long-term, large-scale asset purchases bought at the institutional level of the government itself. Let's keep going. We quantify the impact of Japan's low rate policies on its government and households. Because of the duration mismatch on the government balance sheet, the government's fiscal space expands when real rates decline, meaning the lower that rates are, the more positive arbitrage the government has in its favor, allowing the government, so let's read that again. Because of the duration mismatch on the government balance sheet, the government's fiscal space expands when real rates decline, allowing the government to keep its promises to older Japanese households. A typical younger Japanese household does not have enough duration in its portfolio to continue to finance its spending plan, and the younger households will be worse off. Low rate policies tax younger families and less financially sophisticated households. So what we are talking about here is basically, and Janet Yellen, and for all of those of you that were surprised when Janet Yellen came in and stopped selling, the longer term treasuries and bonds like the 10 and the 20 and the 30 in favor of 2-year treasuries. She is following the same platform. And when we had that really huge August pullback on August the 2nd, August the 5th, at Monday, August the 5th, you saw a lot of worry in the markets that would force America's hand to start issuing, needing to go out and sell a much bigger pile of longer term notes. And the Federal Reserve has come out and said, and the Treasury has come out. They're so interconnected, it's hard to keep them straight. The Treasury has come out, Janet Yellen has come out and said, in fact, that is not the case. They are not going to do that. So they are really financing this government in a very similar way to Japan. And it is a duration mismatch, and it is problematic. What this is doing is when you only finance the government for 2 years at a time because you don't have debt that is going to stay on the books for longer, it doesn't have to be rolled off for but 5 years, 10 years, 20 years, you are having to refinance this debt at potentially a higher cost of capital. And so that's exactly what happened as the Federal Reserve began to raise rates in 2022. And Yellen has had issued since Biden took office in January of 2021, if Yellen is financing the government with short-term treasuries, they're going to turn over every 2 years. She's refinancing them after the Federal Reserve has raised the rates. So now she could have had locked in cost of capital for 20 years at what they were previously at before the Fed raised, but because she financed everything with such short term, she has a problem. America has a problem. And we're going to explain America's problem by going back into what, in fact, is Japan's problem. Because again, the U.S. has really taken this financing structure from Japan. If you can lend on a short term really low and invest on the longer term and earn yield that's a lot higher, that's that positive net interest income or positive arbitrage that you are earning money on. That's how banks make their money. So this is what the financial services industry is used to doing, but we're not used to seeing it at the central bank level, and certainly not to this magnitude. So what ended up happening, just to kind of give you guys, before we go into that slide, I'm going to pull myself up here. What ended up happening was Japan went into stagflation. And so when their market crashed in the crash of 87, they really have not fully recovered a robust growth-based economy since that time, even with all their technology, even with all of their cars, even with all of the even with the exporter that they are. Why haven't they recovered? And it's simply because they have had negative interest rates for the longest period of time, over a decade. And so what happened was two events happened beginning in March that really began to change the dynamic of this situation between the US dollar and the Japanese yen. What did they do? And on March the 19th, they raised their rates for the first time since 2007. So we're in 2024. So we are talking about something that has not changed for 17 years. They have not had a raise of rates for 17 years. And the effective rate has been negative in Japan. So basically what is happening is they decided on March 19th to raise to positive. So basically they went from a negative range to a 0 to a plus 0.1 or 0.1%. So their range, what their equivalent of the Fed funds rate is that the Bank of Japan sets as a policy, just like our Fed funds rate in the United States that the Federal Reserve sets as a policy. Their range after the March 19th interest rate raise was 0 to 0.1%, whereas right now our Federal Reserve Fed funds rate has been at the 5.25 to 5.5 or 5.2555 range since we stopped raising July of 2023 when our last raise was. So what this means is that the Bank of Japan has finally, for the first time, either a net neutral 0 interest rate or a 0.1% positive rate, depending on the effective yields based on what the Bank of Japan set as their policy. Then came July 31st. On July 31st, the Bank of Japan raised for a second time, and they raised from the 0 range to the 0.1% range, for 0 to 0.1% to 0.25%. So basically, you could say that they went up anywhere from 0.24 to 0.25%, from a 0 to 0.1% range. And so all they raised was rates 0.25%, not a substantial raise. And from that raise on July 31st, you start to see a lot of machinations. So it was Wednesday, July 31st. Then on Thursday, we had some additional bad economic U.S. data come forward. On Friday, August the 2nd, is when we got the July jobs report of 114,000 jobs. So now what you were starting to see was you had a double whammy impact of a raise from the Bank of Japan on Wednesday, July 31st. And 2 days later, you had the U.S. basically announce in its jobs numbers that the jobs was a big miss. It was a big miss from the 185,000 jobs that we were expecting. And it was a big decline from the previous month's, June's payroll of all the jobs we had added in June. So the bottom line is the market started to globally unwind what we call the carry trade. Now, why are a lot of Wall Street blamed the U.S. jobs report from July as the reason that we had Monday, August the 5th? where the S&P and the Nasdaq was down massively. It was just a huge loss day. It was a really ugly day. And then we had turnaround Tuesday in the trader world. Turnaround Tuesday, we had turnaround Thursday, we had turnaround Wednesday. In the trader world, turnaround Tuesday basically means, okay, whatever happened the day before, the world is no longer concerned about it. It has been rectified, and we're moving on. We're going back to positive territory. This is such a market that is run by so much pure momentum of belief and feeling on AI and the AI runway. So you saw a lot of people pull out of NVIDIA on the 5th, and we had really big pullbacks. Well, subsequent to it's August 14th now. We've seen recover. We've seen turnaround Tuesday, turnaround Thursday. We saw last week. We saw that the S&P and Nasdaq and the Dow are starting to retrench back, and in fact, they have gathered, and we're not nearly exactly what we were. I'll just give you some real-time data as we are here. But if you look at Nasdaq, for example, Nasdaq's top end of this year occurred on July the 11th. So the highest trading day of the year was July the 11th, when it closed at 18,671 and 0.07. And right now we're at 17,272. So you can see that we are way off still of our high. But regardless of being off of our high, our NASDAQ 100 return still for the year is positive 12.96% as of yesterday's close. If we look at the S&P 500 year to date positive return, it actually now is outpacing NASDAQ. And that's because NASDAQ had a bigger pullback in AI, but it's outpacing NASDAQ to the tune of, again, NASDAQ is 12.96%, and this is as of yesterday close. We're seeing that the S&P is almost 15% return, 14.89%. And then we look at the Dow, and the Dow is obviously our industrials, and that right now has also returned a decent 5.51% for the year. So basically all of this to state that even though we, in fact, are down from our highs on July the 11th, we have, in fact, still are positive year to date. And so if you are concerned with the things that I'm about to share with you, this would be a time to potentially take some profits, get your wins in because of this unique window of time that we're in that I think is unfortunately going to be ultimately problematic for all of us. So basically, let's talk about this carry trade and what it is. So when Japan had stagflation and really had to just pay basically people to invest in the yen with negative interest rates, what you saw is arbitrage. Arbitrage is where there's some price differential somewhere in the world that you have the means and resources to go out and effectively utilize. So if I can buy widgets, we used to call them in business school widgets, because it doesn't really matter if you're selling a good or a service, it's all a commodity of some kind. It's commoditized at some kind of, it's interchangeable service, it's commoditized. So if you are selling a good or service anywhere in the world, and there is another place that you could buy that good and service and use it to deliver your offerings cheaper, that's called arbitrage. So what happened was when Japan went into stagflation and has been in stagflation and had negative interest rates, it would actually be cheaper for investors around the world to go to Japan, borrow and take out loans in yen, and then take that yen and go exchange it for dollars and make an investment in dollars. But because the dollars were so much cheaper, because it was truly yen that we borrowed in yen, as the yen remains extremely depressed against the dollar, there's no problem. You're positively making an additional differential on the financing component of what you're doing. And so you can now start to bring in financial arbitrage to keep your business going. This is what the Bank of Japan has actually done. The Bank of Japan has done this to the tune of $20 trillion, according to the research done by Zero Hedge. So what that means is the Bank of Japan has basically created and lent out yen at X percentage, and then basically borrowed some of their own yen to invest in other outside investment at a much higher percentage. This was all fine when the yen was in the negative range or in the extremely low positive range like it was before July 31st. But once you raise the target range to 0.25%, you actually have an increase of about 17% on the interest expense and financing costs. Because remember, we went from just in March, we were in negative rates. We went from negative rates in March to 0.25% by July. That is a huge swing, even though it's only 225 basis points. It's only 25, a quarter of 1%. It is still much bigger compared to what it was before, which is the amount that people financed or bought the yens at. They bought them at a negative rate, and all of a sudden now they have to actually pay for this yen. And that completely changes all of the financial transactions that have occurred using this carry trade arbitrage. The reason it's called carry trade is because you're carrying the yen away to trade to dollars. You're carrying to trade, carry trade. So basically, the financial machinations and calculations of all of these carry trades that had been done in yen began to cost much, much more. When things begin to cost more and you don't have a full deposit to cover your investment. So if I go out and buy bonds, I'm just going to make up numbers here, you guys. What if I go out and buy $10 million worth of bonds? I don't give the bond seller necessarily $10 million. I might only give the bond, and bonds are a bad example. I should probably use stock because you can buy stock on margin. Bonds are a bad example. So I'm just going to stick with the bonds anyways. So if I invest in bonds, I can do that with leverage. I can say, okay, I want you to sell me 500 bonds, but I'm only going to give you the upfront for half, 250. And the rest is what we call on margin. You can call it based on the parameters of our contract, but right now even though you're allocating and you're selling to me 500, I'm only giving you the money for X amount of the purchase, and the rest is on margin. So what happened when the yen carry trade started to unwind because of the financial changes in the transaction mechanics, you had a lot of people that with margin calls started to get margin called. In other words, oh gosh, the yen is appreciating, and when the yen is basically the yen was losing value. So we were at one point in around July when they decided to do this, we were at almost 162 yen per dollar. So the yen was depreciating versus the dollar. It takes more yen now to equal $1. So they didn't like that. That is really expensive for Japan. They can't just let their currency just evaporate versus a strong US dollar. So they decided, let's raise our rate. And when they raised rates, that dropped the conversion of yen to dollar to about 146 or 142, in the range of 142 to 146 yen to dollar. So it appreciated the yen and lowered the dollar. Remember, all of these investments were made in dollars. So as the value of the dollar went down in comparison to yen, there were a lot of margin calls that people needed to put up more capital to maintain their margin of reserves. And so a lot of liquidity generated events occurred from that reverse carry trade, the reversing of the carry trade. Let me go back and extract my investment out of dollars. Let me convert it back to yen. And if the yen are appreciated, it's going to be more expensive for them. And then I will then be fine. So what you saw was the beginning of the unwinding of this carry trade. However, you saw it on the commercial side. So JP Morgan did an analysis of how much in commercialized investments are in yen dollar arbitrage relationships. And they said that the number was about 4 trillion. And they said that it has not been completely unwound, that 4 trillion, but it has started. We don't know exactly how much has been unwound. This has all just happened in the last, 10 days. It is only August the 14th, and this happened on August the 5th, July 31st. What we do know is that the Bank of Japan has likewise done something similar. This has been a very big article written also in Zero Hedge about the Bank of Japan has done this to the tune of about 20 trillion US dollars. So the 4 trillion that we were discussing with JP Morgan, that is not at the central bank commercial level. That is not the Bank of Japan level. That is the commercial transactions that are private commercialized transactions. Those are not the institutional central bank transactions, and the carry trade that has to be unwound there. So I tell you all of this to let you know that thus far, the carry trade has stabilized since Monday, August the 5th. So it's just been 9 days, has so far stabilized. And right now, the Japanese yen, it's staying right around 146.84. So we're at 146.84 yen to the dollar. We're staying in that range. And really, nothing has really developed since then. But the point is that what we're starting to see now, as we start to see just the yen dollar continue to fluctuate, if we start to see any of that, we're really concerned that the Bank of Japan in and of itself, the institutionalized central bank of the country itself, is going to have these problems. And they already have. And what they've done so far to handle these problems is the fact that you have a problem like this, and you can't almost seem to fix it, because the fix of it can be worse than the actual original problem, if you can even believe that. So let me just give you an example. Let's just pretend that the Bank of Japan went out and bought U.S. Treasury bonds. Let's say that they bought notes, longer duration, higher yield, everything's fine. But then they raised their domestic rates. Now the net interest income is different, because now they've raised their rates and it's more expensive to have the yen dollar arbitrage. So what ends up happening is the Bank of Japan, that previously had negative rates on the liability side, what they had to pay out, that was more than offset with the positive yield that was coming from the investments in U.S. notes. But once the interest rates went to positive, and again, remember, that's a 17% swing. It's a huge swing. So we're talking about a 17% increase in liability or expenses. Now they have to change out the assets to get more yield from the assets to cover the additional cost and interest expense. But they can't do that with U.S. Treasury notes and bonds, because those are already set. And if anything, those have we didn't buy necessarily those things when rates had gone up beginning from 2022 to 2023. So I know this is getting really complicated, but this is an extremely complicated financial topic. To explain it in layman's terms is really difficult. The bottom line is, what the Bank of Japan has had to do is go out into a more risky investment pool and find assets that are returning more interest than the safe U.S. Treasury investments, Federal Reserve investments. So what is happening is you've got Bank of Japan going out and selling bonds at losses and buying CLOs, collateralized loan obligations, leveraged debt, basically. This is a recipe for disaster. They have to increase their yield and their earnings on their investments, because remember, those are longer duration, and they are paying small interest in a shorter duration to their households. So they have to keep that longer duration investment higher. And what they've done, and I'm not saying they've done this with their entire portfolio, but what they've begun to do is to sell off the more secure, longer term duration assets for some CLOs to get yields up. CLOs are, oh my gosh, it's just leveraged debt. It's leveraged debt. You have a bunch of medium-sized businesses in the world, even some bigger-sized businesses that maybe have their rating as junk for some reason, which is BBB or below, and for whatever reason they can't get financing. They go to what we call mezzanine financing, and they get multiple investors, and they basically put packages together to lend to corporations that are considered junk sets that otherwise wouldn't have a lender. And because these are kind of not loans of last resort, that's not the right way to describe them, but because these are more risky loans, their interest rates are much higher. So now you've got a situation where, in order to continue this long-term situation that your Bank of Japan has been using to finance their economy in a stagnant type of situation for over a decade, they are now raising that in the investment to a much higher credit risk, and a much higher probability of default in order to keep the positive arbitrage going. So this is a problem for Bank of Japan. This has not even really begun to be unwound. And if it gets and becomes unwound, then we're going to see literally, unfortunately, I believe it would be the match that would strike the ability to deflate the financial asset bubble that we are in since 2008, since rates have been, and this is globally now, I'm not just talking about Japan, I'm switching on to globally. Since 2008, we've had extremely low interest rates since the global financial crisis or the great financial crisis, the GFC. And those interest rates have been leveraged to buy and invest in assets at extremely low cost of capital. And as you raise that cost of capital, you will see those asset bubbles be pricked and collapse. So this is all to say, I am 20 plus minutes into this podcast, and I just want to tell you that you cannot listen to Wall Street telling you everything has now been rectified. That was a rumbling of what is to come. And now that we have reached the 90 days prior to the US election in the beginning of November of this year, we are getting a lot of global intelligence from our colleagues that talk about the fact that we are and will have some sort of cyber attack. We will have a grid disruption before the election. We also know that the World Health Organization is right now meeting to discuss declaring monkeypox an actual global pandemic. It hasn't reached the globe like coronavirus did, but the WHO garnered a lot more power after 2020 coronavirus. And now if just one country is impacted by a new plague, pestilence, pandemic, whatever you want to call it, the WHO can create and call for a global pandemic with their new health regulations that just passed immediately. And that does have some legal implications for all of its 194 members of the WHO. So we expect some sort of cyber disruption of the grid. And that's NASA coming out and say we are going to have a 100% probability of another solar flare. We just can't tell you when. That's based off of intelligence from groups that leverage attacking electrical grids and infrastructure in order to dismantle and destroy the ability of a country to defend itself. And then this pandemic, and then the market being so unstable. So this all around is not a time to think that everything is fine and that you should be super balls, pedal to the metal, aggressive, because I'm telling you, these 90 days are actually I am quite concerned about these 90 days. And then the last thing I want to show you here, you can see this is the zero hedge. This was an article that was written in December of last year, December 7th last year. And it's talking about the 20 trillion carry trade that will destroy Japan. And this is 100,000% talking about the government of Japan. This has nothing to do with what Morgan Stanley was talking about, the 4 trillion in commercial transactions. And I'll just read this to you. As DB chief FX strategist, FX for foreign exchange strategist George Sarvavelos explains, when one strips away all of the political BS, the government of Japan is engaged in one massive 20 trillion carry trade. So this has just begun. We are nowhere near this being through, done, completed. It has just begun, and we are here for it. And we are here to talk through it. The practice is so much work right now because of our growth. And so I will try, as things really do start to begin, I will do my absolute best to come on here once a week and give you guys some insight and some updates. But this is just my hobby and what I do for fun. And I have been just really super busy. So please forgive me if you're waiting around for my next podcast to give you market information. I don't know if that's super smart because, again, I make no commitments on how often I'm going to do this. I'm going to show you the CNN Fear and Greed Index. And this came out to really kind of give people an idea of where we are. You can see that this was last updated today, and it is still in the extreme fear. In fact, it's actually gotten worse in the last week, which is really interesting. But you can see that literally if we look at where this was previously, because that is the cool thing for us to look at, is where was this fear and greed index previously? And you can see, you can see right here, this thing is just taking its time. I'm so sorry about that. But you can see that just at the previous close, which was yesterday, it was a 24. So it is actually up. And last year it was a 19. Extreme fear, but it was a 19. So that's actually worse. And then a month ago, it was neutral at 54. A year ago, it was at greed. So last year, basically, we had people believing that, oh my gosh, we've got AI. We were all the way over here, you guys, in extreme greed. And now we have dropped to extreme fear. So what this tells me is that the market is already understanding, investors are already understanding that this has changed. Things are different and they are not fully resolved. Even though we got turnaround Tuesday, even though we got another turnaround Thursday, the market understands things are changing, things are disrupted right now, and they are not going to be back to normal in the near future. So especially these next 3 months of time leading up to the U.S. election. I think that is going to be a very tremendously impactful, eventful time. So if you think that you're just going to have a nice fall through until November, no, I don't think that's going to be the case at all. But let's see. Let's hope that we won't get any crazy stuff happening until right before, although I highly doubt it. So we will be here for that. I will definitely be back engaged with you guys. I really appreciate you hanging in there with me on this podcast. Someday I'll retire, sell my business, and just do this for fun. But now that's another year or so. That's a long time from now. So hope you guys are doing great. Have a great ending out of this summer and get ready for some crazy things. You know, it's a good thing that we went through coronavirus. We can use that as a test case. I do think that this next pandemic is going to be way different based on the veracity of this actual pandemic. But I do think that we learned a lot from coronavirus, and those are the lessons to apply, is to remember everything that they said and how it all turned out, and maybe do things a little bit differently this next time. So hope you guys are having a great summer, closing it out. And until next recording, I will talk to you then. Take care.